This Week in Economics from WBRN Radio and on the Bostonred Network. This is one of our family programs here on the Numbers Man channel. We have Bostonred, the the political channel, and we also have our software/hardware development. It's open source or libre, both of those terms are there, and we talk about software development and also the economics of IT, information technology. I invite you to check those programs out on Stitcher, on iHeartRadio, on Speaker, the YouTube channel. We're in audio there. We're coming with the visual part soon. We at one time on live stream did in fact have the visual part so we could show our charts and what have you. We started our endeavor as one of two basic projects at Cranston Software, an econometric model that we started out called the Seesaw model, and our political model known as the Ouija board. Very interesting. We started those models out in the 90s, and at that time our economic arm was known as Cranston Econometrics there, and we were doing work primarily with the Federal Reserve and with some others. We then enlarged our model to cover many things, and in this broadcast we'll be talking about PCIs. That's from the market people, and they are known for these various PCIs. We'll be looking at a manufacturing sector in the U.S. and also the EU zone. The Trump administration is on a trade mission to Japan. Very interesting situation there, looking for investment, as they call, opportunities. The models are different for various nations. China, their business model is to emerging nations, just as China. What you get in an emerging nation is, particularly across the 52 nations on the African continent and in Asia, is a much younger population. That's something to be noted. If you are planning on a classic capitalist development model as defined by Adam Smith and then Dr. Karl Marx. And there are many books written in recent years about the limitations of modern industrial capitalism, or just capitalism. We'll leave it at that, because of the manufacturing part of it is not as broadly emphasized as one would think. Now, China, a totally different economy, India to a certain extent. When you have an internal economy of 1 billion plus people, you have a captive market for your manufacturing and for your consumer offerings. And of course, what China is doing now, they are utilizing their domestic market. At one time, most of the activity, or a lot of the activity they had, was based upon their exports to the rest of the world. Now the situation is different than it was at one time. And the U.S. in its so-called trade stance is looking primarily at exports from China, and there are some imports there. But the problem is, with any import, you have a market today, we'll say soybeans, but the U.S. is not the only nation in the world that is supplying soybeans. So new markets are opened up, and the old markets are de-emphasized, and at some point in history would be completely replaced. Now take for instance the automobile market and the manufacturing there. This would go to Japan. Yes, Japan builds plants in the U.S., and Japan is a different nation in that it has a declining population after coming out of a decade of what is termed as deflation. Now, it would invest in certain nations, but the U.S. itself has demographic problems as the population grows older. And the whole political side of immigration, we were just looking at a business in Philadelphia started by an immigrant from Czechoslovakia. He has a translation service, and to get the B1H type of visas now, it's much more complicated. The background checking is much more detailed, and he used to utilize, I'd say, I believe, 2 per year. Now, the last year he did not even attempt to do it. So that's a new slant there. And the present administration has focused on what one would term a 50s, 80s type economy. We've had stimulus in the economy that you normally apply if you look at a classic Keynesian economics and neo-Keynesian economics, whatever you want to call it, in times of downturn. But we have those types of elements in the economy, massive $1 trillion tax cuts to stimulate the economy across the board there, and also at the same time this emphasis on manufacturing, which the start of it in the 80s was a de-emphasis on manufacturing, and under the President George H.W. Bush, the so-called New World Order in the late 80s and in the 90s, the WTO, this whole situation that to move basically manufacturing out of some of the more quote-unquote advanced nations and into the emerging markets because of labor being cheaper. But as emerging markets now, China for instance, it costs more. They moved on to, say, Vietnam, on to Bangladesh, etc., and ultimately to Nairobi. Now this is a strange twist here when we look at the technology 5G. Is a mobile technology, will be a game changer, and the most advanced enterprise in the world, from numerous people have stated, is Huawei. Now, if Huawei is advanced, it's a Chinese enterprise, and China has raised now questions of their economic sovereignty. Now, this used to be the kind of stuff that people, nations went to war about, were fought over economic, quote-unquote, sovereignty, such as the Great Patriotic War, with a carryover from the quote-unquote First World War. Germany felt their economic sovereignty had been trampled upon, and they decided to trample upon the world there. So that was a program of violence. Now what we have is economic violence, various sanction regimes, tariff regimes on various nations to shut them out. What effectively will happen is that nations like Iran, who has had sanctions on it since 1979, developed various industries within the Korean Democratic Republic. Therein have developed their industries, but they are aligned with the South, that's the Republic of Korea, and also with China. So you're starting to see new formations, and the advent of cryptocurrency, more and more of it. Facebook is going to start their own brand of cryptocurrency. Several banks have dabbled in this. There are crypto markets out there. They are volatile, but so is the U.S. Stock market. So this is our introduction here, where we try to set things as they are. Now, as far as the U.S. economy in Q2, we'll look at some of the models that are projected where to be in the 1.2, 1.3. Because the economy now is, the U.S. economy that is maintained by artificiality. In other words, the psychology of the market itself. A lot of it is fueled by so-called buybacks. We'll get to that from CNBC. And we'll shed a little bit of light on what is going on there. So thus, the stock market and the volatility index, I'm not sure we'll have that this week, but it's highly speculative. We'll look at Petro from the U.S. Energy People. So let's get on with it here. And I think where we'll go is we've covered some of this. We'll go to the U.S. Energy Information Administration. Petro gas prices this holiday, and happy Memorial Day to those. Weekend are about the same as last year, and the 2019 regular prices average about $2.85 per gallon. Nationally, that was on May the 20th, slightly lower than last year's price of $2.92 per gallon. There was last year. Now, let me just get to more here. And anyway, nonetheless, regular retail gasoline prices will increase in the coming months. Summer driving season there, averaging about $2.92 during the summer season. That's in 2019 here through early September. Last summer, wait a minute here. Gasoline prices typically increase, no doubt, during the spring and the summer driving season. Higher gasoline consumption is putting additional upward pressure on prices. As of May 10th, the 4-week average gasoline demand was 9.4 million barrels per day. That is a 0.5 higher than last year. And in association with, again, we go to experts at IHS Market. More than 37 million Americans will travel by a car this weekend. That is a 3.5% more travelers than last year, and the highest travel volume since 2005, before the Depression. Decreasing gasoline inventories, including finished gasoline and gasoline blending components, are also continuing to increase in contributing to increase in gasoline prices, although the inventories are higher than normal because of the range of seasonal values, etc. there. U.S. petroleum product movements tend to follow the international benchmark Brent crude spot price, allowing the bench price has increased since the beginning of 2019. It remains below its value. At this time last year, Brent crude was averaging, $71.25 per barrel this week of May the 10th. are 7% lower than the same week in 2018. Brent crude prices during 2019's summer season is to average, and this is it's $73 or $2.31 more per barrel. And we get to other pages of this on, so I won't go into all of it, but some of the monthly climbs here. The U.S. Gulf Coast region, defined as the Petroleum Administration for Defense District, generally has the lowest retail prices year to year. The Gulf Coast prices have averaged 30 cents a gallon lower, whereas we go to the West Coast, the average price there is 67 cents higher. We're talking about California and those various places. So that is gas prices and where the consumer is here. Now, let's I think we'll do J.P. Morgan here. They have slashed their forecast as for Q2 outlook to 1%. And on Friday, having the previous estimate of the U.S. economic growth in Q2 to 1%, following the data shown the fall in durable goods orders. The bank now sees as a basic coin toss for the Federal Reserve to raise or cut interest rates compared with its previous call for a rate increase. Well, many analysts have called for a rate increase, and that's a very interesting situation. Can you have a rate increase at a time when your second quarter growth is forecast has went down? The answer to that is yes, you can. And this is from Michael Ferroni. This is a research note. We now see the risks of a next move as above, evenly distributed between hike and cut. Well, you can always hike a rate and cut it later. But if you cut a rate and start that regime, you're going more and more into the basket of what is called negative interest rates. And that is a totally different situation there. Let's slip over to Goldman. No, we don't want to do them. In Mexico, the economy is shrinking there. It shrank in the Q1 from a previous 3 months of data shown there. The economy shrank 0.2% compared with October-December period, as the service and industrial activity dipped. The first contraction since Q2 of 2018, according to data from the National Statistics Agency. We'll take a look at that. The contraction was particularly sharp in March. Now, since that time, we've had a deal. March was a very bad month for economic activity, clocking at 0.6 contraction. The Mexican Central Bank member there tweeted. Goldman Sachs economist Alberto Ramos said strikes and fuel supply disruptions early in the year contributed to the slump. The data published benchmark stock index, that is the MXX, fell 1% to a 2-month low. The peso dipped into negative territory. Economic Research Consultancy Capital Economics cut Mexico's growth forecast to 1.8% for 2019. The weak Q1 GDP figures means the economy won't, barring a major surprise, grow by the 2.5% projected there. That is from William Jackson. He's Emerging Economies at Capital Economics under Manuel Lopez Obrador. Investment is growing, and I said yesterday our currency is as strong as President Obrador. Mexico received some $10 billion in foreign direct investment in Q1. That's up 7% from the same quarter last year. Inflation was slightly lower at 4.43. That is very good. The peso has appreciated 6% since President Obrador has brought in a more modern outlook. Adjustments have to be made in the Mexican economy. There's no doubt about that. In annual terms, Mexico's economy expanded at just 1.2%, slightly lower than the 1.3% preliminary data. So, from the Instituto Nacional Estadística Geográfica. Sorry about my Spanish here. But we'll look at it anyway and see where they are, because Mexico is a very, very important economy, no doubt about that. And we'll look at some of their figures. I've not looked at their index before, and let me just see here if we can go to, when in doubt, break out the translator. All right, okay, and we'll see this. We are live, so it's and unfortunately here. We are, where are we with this? We're going to have to go back. They've divided this up. I'm just looking here at some of the figures here, and effectively it is the same thing here that was out there. And wait a minute, just a second here. Datos, yeah. Anyway, we're probably going to have to leave it as is and move on. But that is Mexico, and I'll look and see if I can get the translation here, at least get that data. We'll get to that. I think what we want to do here is go to the PCI so we can solidify where we were. This is the market PCI, a flash U.S. PCI, business activity growth, was flattened to a 3-year low. This is released incidentally on the 23rd. We're at the 25th now. And this is key findings. The output index at 50.9. It was 53 in April. This is a 36-month low. The Service Bureau Activity Index at 50.9. It was 53 in April. That's a 39-month low. That shows a trend of stagnation. The flash manufacturing PMI is at 50.6. It was at 52.6 in April. This is a 116th month low. The flash U.S. manufacturing output index at 50.8. It was 52.7. This is a 35-month low. The May PMI data reveals a further slowdown in the U.S. private sector outgrowth in May, as a sluggish manufacturing economy was accommodated by a notable downshift in the service economy. At 50.9 in May, down from 53 in April. The U.S. seasonally adjusted IHS market flash U.S. composite PCI outlook index indicated that the slowest expansion overall slower since May of 2016. The composite index is based on the original survey data. And let me get back to this. And we'll just up this a little. Muted rise in output was attributed to softer demand conditions, subdued growth in new orders. The rise in new business in May was the softest recorded since the series started in 2009. That was in the Depression. Consequently, firms put the brakes on hiring. The latest increase in employment was only marginal and the smallest for just over 2 years. Companies also noted a little strain on capacity due to weak demand and reported first decline in back orders since June of 2017. Input price inflation eased for the third month running in April, despite a continual comments from panelists regarding the outgoing impact of tariffs, the slowest increase in costs, and a greater competitive pressure underpinned a renewal fall in output prices, the first decline since 2016. U.S. private sector firms, meanwhile, grew less optimistic, and this goes to the psychology of the economy. A rise in output over the 12 months, business expectation fell to its lowest since 2012. Reduced confidence was commonly attributed to hesitation amongst clients and increased uncertainty. Were both there. The IMS U.S. Service PMI, seasonally adjusted there, posted 50.9, and it was down from 53 in April, to indicate a notable slowdown in the service sector. The service sector has imitated the manufacturing sector. Manufacturing was king in the 50s, the 60s, and in the 70s started to wane a bit in the bottom part of the 70s, and of course in the 80s it fell flat. The U.S. manufacturers also indicated a slower expansion in output in May and further signs of relatively subdued conditions. That's the manufacturing PMI. The Purchase Managers Index registered at 50.6, down from 52.6, that's 2 points in April, although the index reading continues to signal improvement operating conditions across the manufacturing sector. The upturn was the latest since September 2009 and only marginal. Underpinning data indicates a broad-based slowdown in the rate of expansion for output, employment, and pre-production inventories, while new orders declined the first time since 2009. That was in the Depression. In contrast to the trend seen for the service sector, manufacturing raised their output prices in May. That said, the rate of increase was only slight. Factory input costs, meanwhile, rose at the weakest rate for 2 years. From Dr. Williamson here, the growth of business activity slowed sharply in May as the trade war worries and increased uncertainty dealt further blow to order book growth and business confidence. A decline in headline flash PMI, the lowest in 3 years, pushed the survey data to a level historically consistent with GNP growth at, and this is where you're getting a reconfirmation of this from what the Atlanta Fed's special model is of 1.2 in May. Worse may be to come as inflows of new business slow. The smallest rise seen on the side of global financial crisis. Business confidence has meanwhile slumped to its lowest since 2012. The slowdown has been led by manufacturing, but the slowdown increasing a sign of spreading to services, the backbone of the American economy. The survey that has been consistent with falling manufacturing output since February, but suggested that the sector's woes intensified in May, meaning factors will therefore likely act as an increasing drag on the economy. Trade wars remain the top list of concerns amongst manufacturers, along with signs of slower sales, weaker economic growth, both at home and in export markets. However, an additional concern is the spreading of malaise to the service sector, growth of which slumped in May to one of the weakest since the global financial crisis, the Depression. With service sector performance being a key gauge of the health of domestic demand, this broadening outlook of the slowdown poses downside risks there. Dr. Williamson is definitely correct there. This is the coming tide, so to speak. From the flash Eurozone PMI, subdued business growth there, also stagnant demand. Eurozone flash PMI composite, index at 51.6. It was 51.5 in April's 2-month high. The flash Eurozone service PMI activity index at 52.5. It was 52.8 in April, a 4-month low, but it had been low. The flash manufacturing PMI output index at 49, and it was 48 in April. The pace of economic growth remains subdued in May. Stagnant demand, job growth slipped to joint lower since 2016 as firms scale back on expansion plans in light of weak sales. Optimism about future meanwhile slumped to a 4.5-year low. The Eurozone composite PMI recorded at 51.6 in April, according to preliminary flash estimate, up only a fraction from 51.5 in April. Input cost inflation across two sectors moderated, the second lowest since November of 2016. Similarly, average price for goods and services showed the slowest increase since July of 2017. Weak price pressure were especially evident in manufacturing, where input costs showed the smallest rise in nearly 3 years. Growth edged higher in Germany thanks to a sustained service sector growth and easing in the rate of decline of manufacturing. Germany's factory sector remains in one of the worst spells since 2009. That's Depression, with steep downturn in exports feeding through to increased job cuts in May. Again, it's the same such symptoms here. Growth also peaked up in France, rising to a 6-month high, albeit remaining subdued and just below the Eurozone average. Elsewhere, business activity growth hit the weakest since 2013. The comments again by Dr. Williams: the Eurozone economy remains in the doldrums, adding to the sign of only a modest growth will be achieved in Q2. It's an indication so far of GNP growth at 0.2%. A renewed deterioration optimism about the year ahead suggests that the business situation could deteriorate further in the coming months. Sectors divergences remain marked, with manufacturing still in decline, and the region therefore relying on a service sector to support growth. While some encouragement could be gained from the manufacturing sector showing signs of its downturn, having bottomed out in March, it's still the weakest, slipped to one of its weakest since 2014. Germany is, of course, is on course for 0.2% expansion in GDP. That is Germany. Let me skip around here a little bit. Now, this is the Atlanta Fed, their GDP now a model that they have been running. Their latest forecast is This is on the 24th of May at 0.3%. That's pretty much in line with some of the PCIs. The model estimates real GDP growth, seasonally adjusted annual rate in Q2 2019 at 1.3 on May 24th. That's up from 1.2 tenths on May 16th. The U.S. Census Bureau released new home sales and construction costs on the 23rd. The nowcast second quarter real residential investment growth increased from 4% decreased, actually, no, increased 4% to 1.6%. The next will be on the 31st of May. I'm not sure about that. I had to look at what I was doing. New home sales. Okay. Anyway, this is some of the average here. Blue chip consensus. A range of top 10, bottom 10 forecasts of there. The growth, real GDP measured by the U.S. Bureau of Economic Analysis is a key metric. We don't have to get over that one. And let's move on here a little bit. This is the monthly advance report on manufacturing shipments, inventory orders. This from the Bureau of Census announced here. Let me just key this up a bit. In April, 248.4 billion. That is a minus 2.1%. This is in durable goods orders. In March, it was revised to 253.8 billion. That was a plus 119. New orders for manufacturing durable goods decreased 5.4 billion, 2.1% to 248.4 billion. That's the Census Bureau announced. Decrease down 2 of the last months, following a 1.7% increase in March. Excluding transportation, new orders were virtually unchanged. Excluding defense, new orders decreased at 2.5%. Transportation equipment also down 2 of the last 3 months. Decreased to 5.4 billion, or 5.9% to 84 billion. Shipments of durable goods in May down 3 of the last 4 months, decreased 4 billion, 1.6 to 253.3 billion, following a 0.5% decrease in March. Transportation equipment down 4 consecutive months, decreased 3.7 billion, or 4.1 billion to 285 billion. Unfilled orders for manufacturing durable goods in April, down 2 of the last 3 months, decreased 0.7 billion, or 0.1% to basically 179 billion, following inventories of durable goods in April, up 9 of the last 10 months, increased at 1.8 billion, 4/10 to 422.6 billion, following a 0.3% March increase. Transportation equipment also was up 9 of the last 10 months, led the increase at 1.5 billion, or 1.1% to 136.1 billion. Capital goods, non-defense new orders decreased 3.9 billion, or 5%, 74 billion. As shipments decreased 2.4 billion, or 3% to 75.9 billion. I want to go over some of these again. Revised March data. New orders at 503.5 billion, revised from 506.2 billion. Shipments at 507.1, revised from 508.5. Well, these are some of the highlights here that happened, and this is the exclamation. We'll put this one on. So effectively what we're seeing is an economy as far as manufacturing in decline, sales in decline, and all of this, the hedge water is very interesting. Q2 has always been a transitional quarter. Q1, of course, the beginning of the year, and Q2 a transitional quarter, and we get into Q3, another very interesting quarter, because let's see, March, we have April, May, and June, and that's the bulk of the summer, where people traditionally factories were on holiday, people were on holiday, transitioning into September. And of course Q4, the holiday season, kicks in there. But if you have stagnation in Q2 and Q3, by that time the psychology of the market and consumer confidence will start to weigh. And the problem with the type of economy that we have at this point in the U.S. is, since it is highly, perhaps we cannot, we will look to find an article here we were looking at, and maybe we'll be able to find it, and maybe we will not. It talked about the market itself and where it was going here. Here we go. This is from CNBC. The market would be much lower if companies were not for companies buying back their own stock. And this is very interesting here. This came out on the 25th by Fred Embred, I think is his name. Data compiled by Nate Davis Research showed that the S&P 500 would be 17% lower between 2001 and the Q1 of 2019. The other options for companies dealing with cash holdings and reinvestments and dividends. Without focusing too much on numbers, we can say that the S&P index would probably be lower today if not for buybacks. That's Ed Kessel. He's the chief strategist at Nate Davis Research. Buybacks have gotten a bad rap from both political parties. The stock market would be trading a much lower level without them. Data, again compiled by Ned Davis Research, shows the S&P would be 19% lower without buybacks. That is what we call artificiality. Then they subtract the amount of net monthly repurchases to arrive at that conclusion. The broad market is up 112%, more than 125%, in that time, while net buybacks have totaled $3.5 trillion. Without focusing too much on the numbers, we agree with that. We don't. We can say that the S&P index would probably be lower today if not for buybacks. And I don't know why we're repeating the same thing here in this article. But anyway, nonetheless, companies have been using buybacks because it allows them to put capital to better use and back in the hands of investors without committing to making those payments over time. That's from Kate Warning. She's an investment strategist at Edward Jones. So, in other words, that is the play of the markets. Let me just check on our time here, and we'll do the numbers while we still can. We'll go over to the BBC. Now, the BBC, the pressing situation there is Brexit. The Prime Minister is on her way out, Theresa May. The Tory party, the Conservatives in the UK, will find a new leader after she leaves. She will stay on until a new leader is selected. And once that happens, if a Eurosceptic is put in, the such as Boris Johnson, there will be more and more chaos coming. Nonetheless, the FTSE 100 at 0.65%. The change there was 46.69. And on to Amsterdam, the 0.64, the change there was 3.50. In France, the change was 35.14. The DAC in Frankfurt was 58.63, or 0.49%. The Strauss at 23.50. And in Madrid, they were at 60.60. In Bombay, 623.33. The Hang Seng was at 86.80, and the Nikkei was down 33.92, or 0.16% down there. And we'll go back to New York. Where are we here? The Dow was at plus 95.22. The Nasdaq at 8.72. And the S&P of 500 at 3.82. And we'll go to Brent crude futures at $68.69. That is a plus 93-cent change there, or in percentage 1.37. The West Texas crude futures at $58.63. 72 cents change there. T-Boone Pickens is still jumping for joy in his retirement, and that's at 1.24% there. Gold was up $5.55 at $1,281.50 on the Forex exchange. So that we have, and I'm not certain anything else we're going to get here. I suppose we pretty much explored the petro position, so we don't really need to do that again. Wait a minute, just a second here. These are top stories. There, we don't. Oh, we'll go to Mega Million. We don't want to forget Mega Million. In micro and not macro, and Mega Million has soared to 4.18 million. A lot of money involved there. This is from CNBC, believe it or not. The Mega Million jackpot, over 400 million. With no one winning on Friday. Oh, we didn't win either. The top prize has been climbing for more than 2 months. Doesn't seem like that when some fellow from Wisconsin won the prize. And that'll be Tuesday night. It's a 24%, incidentally. A federal withholding would reduce the amount to 63.1 million. The top margin of 37%, that's where you would be. And assuming you have no deductions from your taxable income, such as large charitable contributions, another 13% would be due the IRS. That would be 97.3 million going to Uncle Sam, plus the state would be knocking at your door. Then there are state taxes, and if you move to someplace that doesn't have one, could be another 8% there. And the top prize winner, this was one on the 28th in Wisconsin. That was a $768.4 billion. Mr. Manuel Franco claimed the haul there, and chose a lump sum option. So he came up with $477 million after federal and state taxes. He still received $326 million. A good haul for the young man there. He's in very good shape. That was Sarah O'Brien presenting us with that particular situation. This will do it for this week in economics. on the 25th of May. You can find us on iHeart, Stitcher, YouTube, Twitter, and let's see, who else are we on? Spreaker. We keep getting on new channels. There are a lot of other channels also. And on Alexa, you can just say Numbers Man and we'll pop up. And the same would go with some of the other so-called smart speakers from Google or Google Home. And there's a bunch of those out there that you can use if you use smart speakers. We would caution you to be very careful with smart speakers. Period there. A happy Memorial Day to everyone. This is M.A. at Cranston Analytics. Good day.